A major central bank is about to collapse. Regional banking crisis is just the tip of the iceberg. Why we haven't seen the crash coming yet. The S&P 500's gains this year are thanks to just 8 stocks, while the other 492 in the benchmark index have fallen as a group in 2023. These include FANG stocks, mega cap tech, Facebook, Amazon, Apple, Netflix, and Google, plus Microsoft, Nvidia, and Tesla. These stocks are currently being traded by boys on TikTok that just quit their job and became a day trader because they got balls. Even the most famous bear in modern history, Mr. Big Short Michael Burry, has capitulated. Investors believe the banking crisis is under control since the Fed is increasing its balance sheet and might pause rate hikes. But is there more to this story? In fact, the banking crisis isn't over. According to Rich Dad Robert Kiyosaki, which major central bank is about to collapse? Why we haven't seen the crash coming yet? I will explain it all right after this. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. Push my button, the like button, if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore, you want it to be real, you want it to be true, you want to be my client, don't you? Here is my book, Believe You Are Worthy. And here's my client's collaboration book, Adversity Equals Success. Such an amazing book with such incredible authors. Order your copy today. The 2-year Treasury yield reflects the market expectation of the Fed's policy post the first round of banking crisis. It dropped below 4%. Lower rates have supported the stock market, as investors expect the Fed to halt rate increases. Investors draw comparisons to previous Fed pauses when the labor market was strong. In each instance, the market rallied to new highs. Bulls argue this supports the current market, but macro factors indicate a different outcome. Domestic banks have been tightening lending standards since 2022. Credit spreads, default risks correlate with banks' lending standards. Tighter standards reduce credit availability, making refinancing harder for businesses and increasing default rates. In 2007, 2008, banks tightened lending standards, causing credit spreads to rise due to high default risks during the financial crisis. Today, there's a notable gap between credit spreads, red, and lending standards, blue. Banks' tight lending standards resemble levels seen in 2008 and 2001. But markets haven't fully factored this in, as credit spreads remain low. In previous Fed pauses that led to market rallies, banks had looser lending standards. lowering default risks, and maintaining low credit spreads. Today's tight lending standards pose a challenge for credit spreads to stay low. Markets need a Fed pivot, unemployment rate remain low, the economy avoid a recession, inflation drops back down to 2%. Unemployment and recession risks remain high. If the economy doesn't fall into a recession, inflation is unlikely to reach 2%, which means the Fed will need to keep tightening monetary policy. Both outcomes are negative for stocks. Historically, stricter lending standards result in credit spreads exceeding 10%. Investors should be cautious of a potential credit crunch ahead. The VIX S&P 500 Volatility Index is highly correlated with credit spreads. If credit spreads reach 10, the VIX should spike to 37 as the markets will quickly move downward. The biggest bank that's going to go down is Bank of Japan. Kiyosaki said, pointing to the bank's heavy exposure to derivatives markets. Kiyosaki has previously said he expected the derivatives market to plummet as the market of other central banks around the world raising interest rates. The Bank of Japan has been financing derivatives. Derivatives are a quadrillion dollar market, which is $1,000 trillion. So we haven't seen the crash coming yet. In my opinion, stocks are headed for a brief rally before an inevitable slowdown in the economy. Risk assets will rise in the next month as April is historically a month of rally. As we move into May, rate hike effects will be seen in the Q2 earnings. I cannot imagine a world in which we raise the Fed funds rate 475 basis points and then trot off merrily into a new bull market. I think we're in a situation right now where we plugged the hole that was discovered sufficiently for the near term, in the sense that depositors were covered. I also am hard-pressed to imagine a world where bank failures and corporate liquidity issues are good news. I think confidence is something that's a risk and is underappreciated by the stock market right now. Frankly, because consumer confidence is something that can change on a dime. And consumers can change the way they spend on a dime. Whereas there's a mismatch then between what consumers can change and how quickly companies can respond. Companies, for example, stock shelves with items to sell consumers, and that essentially forecasts an economic outlook as far as a year ahead of time. But consumers could change their mind with buying habits on a daily or weekly basis. Meaning corporations could get caught with the wrong inventory or too much inventory. That's one of the bigger risks which would manifest itself in corporate earnings. Banking crisis causes recessions. An obvious consequence of a banking crisis is a tightening of lending standards. Given the lifeblood of the economy is credit, both consumer and business. The tightening of lending standards reduces the economic flow. Not surprisingly, when banks tighten lending standards on loans to small, medium, and large firms, liquidity constriction ultimately results in a recessionary drag. Many businesses rely on lines of credit or other faculties to bridge the gap between manufacturing a product or service and collecting revenue. If lines of credit are withdrawn, businesses must lay off workers, cut expenses, and take other necessary actions. The economic drag intensifies as consumers cut spending, further impacting businesses due to reduced demand. This cycle repeats until the economy slips into a recession. Having been an investor through the 2008 financial crisis, and having looked at the seminal moment when Bear Stearns and JP Morgan combined, the next quarter was great for markets. Equities went up 15% to 20%. High-yield credit spreads retraced a quarter, and then the bottom fell out. You could have a feel-good period, and then the reality of the cumulative lag catches up and slows the economy down. Investors should not lean into the rally, as gains will be fleeting. If we've been taught anything this past month, you may see it coming or you may not. It could be Bank of Japan or Bank of England. You don't know exactly where it's going to hit. Referring to the abrupt failure of several banks in March that caught markets off guard. But once it hits, whatever you own, it will go down, and you have to hope that you own the companies that will recover. Remember, most bear markets occur after the Fed's policy pivot. The reason is that the policy pivot comes with the recognition that something has broken, either economically, aka recession, or financially, aka credit event. When that event occurs, the Fed initially takes action. The market reprices for lower economic and earnings growth rate. Thus, bear market continues. Robert Kiyosaki always laughs at people who go to school to become a PhD. He said they are poor, helpless, and desperate because first they need a loan to go to university. As of today, our Ivy League universities, where according to the new report from Bloomberg, prices for tuition are now approaching $90,000 per year. This means a full 4-year education costs over $300,000. In many cases, you can start a successful business for less than that kind of money, and you can pass it down to your kids. A degree can't pass it down. Okay. Kiyosaki has been bearish on the market for years, predicting in 2021 that investors would soon see the biggest crash in the world's history. He warned that the rising interest rates were bound to bust through inflated asset prices, and urged his followers to invest in Bitcoin and precious metals like gold and silver when the crash finally happens. Oh, I'm just going to remind everyone, the like button, please. Thank you. You are such a good boy for watching my video right till the end. Bye.